Across the world, governments keep promising solutions, yet outcomes feel smaller, slower, and more limited than before. Policies that once stabilized economies now seem to lose effectiveness quickly. Growth no longer fixes underlying problems, and every intervention appears to create new constraints. This has created a quiet sense that something fundamental has changed. To understand why governments feel boxed in today, it's necessary to look at how economic options gradually narrowed. For much of modern economic history, governments relied on a familiar toolkit to manage crises. Hand slowdowns, including borrowing more, cutting interest rates, and increasing public spending to stimulate growth. These tools worked because debt levels were manageable, populations were growing, and productivity gains helped absorb costs over time. When economies slowed, governments could act aggressively without immediate fear of destabilizing finances. Over the last decade, however, that flexibility has steadily eroded. Public debt expanded across advanced and emerging economies alike, not because of a single mistake, but because repeated shocks demanded repeated intervention. Each crisis was treated as temporary, but the cumulative effect permanently raised baseline debt. At the same time, interest rates eventually rose, turning what was once cheap borrowing into an expensive constraint. This changed the nature of policymaking. Every decision now carries a trade-off that is harder to avoid. Spending more risks fiscal credibility, while spending less risks social backlash. Cutting taxes strains budgets, while raising them slows growth. Central banks face similar limits, caught between controlling inflation and preventing financial stress. What makes this environment different is not that tools disappeared, but that their costs became immediate and visible. Markets react faster, voters are less patient, and errors are punished quickly. Governments find themselves managing expectations rather than shaping outcomes, focused on avoiding damage instead of pursuing ambition. This shift transforms economic leadership from proactive to defensive. Options still exist, but each one narrows the path forward. The result is a system where action feels riskier than inaction, even as problems grow more complex and interconnected across global economies today. If governments hesitate because every option carries a cost, what happens when inaction becomes even more dangerous than action? As government debt accumulated over years of crisis management, policy decisions stopped being straightforward and became exercises in trade-offs. In earlier periods, borrowing more to stabilize the economy carried limited immediate consequences because growth and low interest rates absorbed the cost. Today, higher debt levels mean every new commitment competes directly with existing obligations. Interest payments consume larger portions of budgets, leaving less room for public investment, social programs, or tax relief. This forces governments to prioritize defensively. Funding one area now requires cutting or postponing another, making policy choices more visible and more controversial. Markets amplify this pressure. Investors no longer focus only on growth prospects. They scrutinize fiscal discipline, debt trajectories, and political credibility. A policy that appears supportive domestically can trigger market anxiety externally, raising borrowing costs and tightening conditions further. This feedback loop narrows options even more. Governments become cautious not because they lack ideas, but because the margin for error shrank. Political systems feel this strain as well. Voters expect support during hardship, yet resist higher taxes or reduced services. Meeting one demand often violates another. As a result, governments rely on short-term measures designed to minimize backlash rather than solve root problems. These measures provide temporary relief but deepen long-term constraints by adding complexity and cost. Over time, debt transforms from a tool into a boundary. It does not stop action entirely, but it changes its character. Policymaking becomes incremental, reactive, and risk-averse. Leaders focus on preserving stability rather than expanding capacity. This environment rewards caution and punishes experimentation. The danger is not that governments will default or collapse, but that they lose the ability to shape the future proactively. When debt defines the limits of action, ambition fades and adaptation slows, leaving economies less prepared for shocks that require decisive, coordinated responses across systems already operating under pressure today. If debt turns every policy into a compromise, how do governments respond when compromise is no longer enough? For decades, monetary policy acted as the fastest and most powerful lever governments could rely on when economic trouble appeared. Cutting interest rates stimulated borrowing, supported asset prices, and restored confidence with relatively few political consequences. Central banks became the first line of defense, often acting faster than elected governments could. But this effectiveness depended on a world of declining rates and expanding balance sheets. That world has changed. After years of near-zero rates and unconventional interventions, monetary policy is now operating in a far more constrained environment. Interest rates cannot be cut aggressively without risking inflation, currency weakness, or financial instability. At the same time, keeping rates high increases debt stress across governments, businesses, and households. This creates a narrow corridor where central banks must balance competing risks with limited room for error. Markets understand this tension and respond quickly to any signal of miscalculation. What once felt like a powerful tool now feels blunt and unpredictable. Monetary policy also suffers from delayed impact. Rate changes take time to filter through the economy, and their effects are uneven. Some sectors feel pressure immediately, while others lag, creating distortions rather than broad stabilization. This uneven transmission reduces confidence in policy effectiveness. Governments find that relying on central banks no longer buys time or clarity. Instead, it exposes vulnerabilities that were previously masked by cheap money. As a result, monetary policy has shifted from being a solution to being a constraint that policymakers must manage carefully. It can still influence conditions, but it cannot easily solve structural problems like weak productivity, aging populations, or fiscal imbalance. This loss of effectiveness further narrows the set of available options. When both fiscal and monetary tools are constrained, governments face a reality where traditional responses no longer guarantee results. The challenge becomes managing limits rather than unlocking growth, a difficult adjustment for systems built around intervention and expansion. If neither fiscal nor monetary policy can deliver easy wins anymore, what tool do governments have left to rely on? As fiscal and monetary tools lose effectiveness, political pressure becomes an additional constraint that governments cannot ignore. Economic decisions no longer play out only in markets. They play out in public opinion, elections, and social stability. Policies that might be economically sensible can quickly become politically toxic if they impose short-term pain. This changes how governments behave. Leaders become focused on managing backlash rather than managing outcomes. Every decision is filtered through its immediate impact on voters, interest groups, and media narratives. In this environment, long-term reforms struggle to survive. Measures that require patience, such as restructuring taxes, reforming pensions, or investing heavily in productivity, offer benefits that arrive slowly but impose costs quickly. Politicians operating on short election cycles have little incentive to push them. Instead, governments favor policies that spread costs invisibly or delay them altogether. This creates a bias toward temporary fixes and symbolic action. Political fragmentation intensifies the problem. Coalition governments, polarized electorates, and weaker consensus make coordinated policy harder to achieve. Even when leaders recognize the need for reform, securing agreement becomes a challenge. The result is drift. Economies continue operating, but with unresolved problems accumulating beneath the surface. Markets sense this hesitation. Businesses delay investment when policy direction feels unstable. Households grow cautious when promises change frequently. Trust erodes not because governments do nothing, but because actions feel inconsistent and constrained. This political dimension turns economic management into risk avoidance. Governments choose options that minimize immediate disruption, even if those options worsen long-term constraints. Over time, this reinforces the perception that leaders are reacting rather than leading. Economic policy becomes less about shaping the future and more about surviving the present. When political pressure dominates decision-making, the range of acceptable choices shrinks further, leaving governments boxed in by both economic limits and public expectations. If political pressure discourages long-term reform, how do governments escape a cycle of short-term fixes without losing public trust? Even when governments try to act decisively, global interdependence limits how far national policy can go. Economies are no longer insulated systems where decisions affect only domestic outcomes. Capital moves quickly across borders, supply chains span continents, and currencies react instantly to policy shifts. This interconnectedness means that actions taken at home are judged abroad in real time. A fiscal expansion can trigger capital outflows, currency weakness, or higher borrowing costs if markets doubt sustainability. A tax change can push investment elsewhere. Trade measures can invite retaliation. Governments must now anticipate global reactions before implementing domestic policy, further narrowing their room to maneuver. This constraint is especially strong for mid-sized and smaller economies that lack reserve currencies or deep financial markets. But even large economies feel it. Decisions by major governments influence global conditions, which then feed back domestically through inflation, exchange rates, and financial markets. Coordination could, in theory, ease these pressures, but coordination is politically difficult. Countries face different cycles, priorities, and domestic pressures, making unified action rare. As a result, governments act cautiously, aware that bold moves could destabilize fragile global balances. This global sensitivity reinforces incrementalism. Leaders prefer small adjustments that can be reversed rather than structural shifts that commit them long term. Over time, this behavior changes expectations. Markets come to assume hesitation, and citizens sense limits. Economic sovereignty feels reduced even if formal authority remains intact. Governments still make policy, but within a narrower corridor shaped by global finance, trade, and confidence. This reality makes national problem-solving harder. Issues that require decisive action, such as debt reduction, productivity reform, or climate transition, become more complex when every move interacts with external forces. The outcome is not paralysis, but constrained motion. Governments keep moving, but slowly and carefully, aware that the margin for independent action has shrunk in an interconnected world. If global interdependence limits national choices, where does meaningful economic control actually reside now? As economic options narrow, governments increasingly rely on institutions designed for a different era, and this institutional lag further restricts action. Many fiscal rules, regulatory systems, and social contracts were built when growth was stronger, populations were younger, and debt was easier to manage. Today, those same structures limit flexibility. Budget rules constrain spending during stress. Entitlement systems expand automatically as demographics shift. Regulatory layers slow adaptation in energy, housing, and labor markets. None of these constraints are irrational alone, but together they reduce responsiveness. Changing them is politically and administratively difficult, requiring consensus that is rare under pressure. This creates a widening gap between problems and solutions. Governments recognize challenges, yet struggle to update the machinery needed to address them. Bureaucracies prioritize stability and compliance over experimentation because failure carries political cost. Policy evolves incrementally while conditions change rapidly. This mismatch frustrates citizens and investors alike. Expectations formed in earlier decades persist, even though the environment no longer supports them. People expect stability, growth, and security simultaneously, while governments operate within tighter boundaries. This expectation gap erodes trust. When outcomes disappoint, blame spreads across institutions, further reducing willingness to attempt reform. Over time, systems become optimized for managing decline rather than enabling renewal. This reflects inertia, not incompetence. Institutions protect against chaos, yet resist transformation. In a constrained world, that resistance is costly. The challenge is not choosing better policies, but updating frameworks that make bold choices possible. Without institutional renewal, governments may appear active while remaining structurally limited. If institutions are built for the past, how can governments redesign them without losing stability today? As options narrowed and institutions lagged, governments increasingly shifted from long-term economic strategy to permanent crisis management. Instead of planning for growth, productivity, or resilience over decades, leaders focus on stabilizing the present moment. Each new shock is treated as an emergency that demands immediate containment rather than structural adjustment. This approach feels rational under pressure, but it carries long-term costs. Crisis tools are blunt and temporary by design. They are meant to stop damage, not build capacity. When used repeatedly, they crowd out strategic thinking. Policymakers become skilled at reacting but less capable of shaping direction. Budgets are written to manage risk rather than invest in opportunity. Political capital is spent calming markets and voters instead of reforming systems. Over time, this reactive posture becomes normalized. Citizens come to expect emergency responses, while long-term plans feel abstract or unrealistic. Markets price in short-term intervention rather than sustainable reform. This environment reduces accountability. When outcomes disappoint, leaders can point to external shocks rather than internal choices. But reliance on crisis management creates vulnerability. Each intervention increases complexity and debt, reducing room for the next response. The system becomes dependent on constant adjustment, like a machine that only runs with continuous manual correction. Growth suffers because uncertainty remains high. Businesses hesitate to invest when policy direction shifts with each shock. Households delay decisions when stability feels temporary. The economy functions, but without momentum. Crisis management keeps systems alive, but it does not make them stronger. When strategy disappears, resilience erodes quietly. Governments may avoid collapse, but they struggle to deliver progress. This is how limited options reshape not just policy tools, but the entire mindset of economic leadership. If crisis management becomes the norm, can governments ever return to long-term economic planning? As governments operate with fewer options, public expectations become another powerful constraint that shapes what is politically possible. Over decades, citizens in many countries grew accustomed to steady growth, rising living standards, and government support during downturns. These expectations were formed in a period when policy tools were more effective and costs were easier to absorb. Today, those expectations remain, even though the underlying conditions have changed. This creates tension. Voters want stability, affordability, and security at the same time, but they resist the sacrifices required to achieve them. Policies that involve short-term pain, such as spending cuts, tax increases, or structural reform, face immediate backlash. Governments respond by avoiding choices that challenge public comfort, even when those choices are necessary. This dynamic encourages delay and moderation. Leaders frame problems carefully, soften language, and promise gradual improvement rather than decisive change. While this approach reduces conflict, it also limits impact. Markets and institutions sense the hesitation and adjust behavior accordingly. Businesses delay investment, expecting policy drift. Households remain cautious, doubting long-term commitments. Over time, a gap opens between what societies expect and what governments can realistically deliver. That gap erodes trust. People perceive inaction or incompetence, while leaders feel constrained by demands they cannot meet without risk. This feedback loop further narrows options. Governments become managers of disappointment rather than drivers of transformation. Economic policy turns into expectation management, where avoiding anger becomes as important as achieving results. In this environment, bold action feels dangerous, even when gradual decline feels worse. If expectations limit action, how can governments reset public understanding without triggering backlash? As constraints accumulate, limited options stop being a temporary condition and begin shaping the future path of economies. Decisions made under pressure create lasting structures. Policies designed to manage risk become permanent features. Temporary measures harden into norms. Over time, this changes how economies evolve. Growth becomes slower, uneven, and more dependent on external conditions. Innovation suffers because uncertainty discourages long-term investment. Productivity gains become harder to achieve when systems prioritize stability over experimentation. Governments adjust to this reality by lowering ambition. Targets become modest, promises cautious, and success defined by avoiding failure rather than achieving progress. This shift affects society as well. Younger generations sense fewer opportunities and lower mobility. Trust in institutions weakens as outcomes fall short of expectations. Political discourse becomes more reactive, focused on blame rather than solutions. In this environment, countries diverge. Those that adapt early, reform institutions, and align expectations with reality gradually rebuild capacity. Those that remain trapped in short-term management fall behind. The difference is rarely dramatic, but it compounds over time. Limited options today shape competitiveness tomorrow. What makes this moment critical is that choices still exist, but they require confronting uncomfortable trade-offs. Delaying action preserves short-term calm but deepens long-term constraints. Acting decisively risks backlash but creates space for renewal. The future is not determined by a single policy, but by whether governments accept limits as permanent or treat them as challenges to be overcome. How leaders respond now will influence growth, stability, and trust for years to come, even if the consequences unfold quietly rather than through crisis. If limited options are shaping the future already, what signal would tell governments that delay is no longer sustainable? At some point, governments must confront the reality that continuously managing limits is not the same as governing for the future. When economic options remain narrow for too long, systems adapt to a constraint rather than progress. Policies are designed to avoid disruption. Institutions focus on preservation, and societies adjust expectations downward. This is how decline becomes managed rather than reversed. The alternative is not easy or painless. Rebuilding capacity requires governments to accept short-term risk in exchange for long-term flexibility. It means reforming institutions that are politically sensitive, investing in productivity before crises force it, and communicating honestly about trade-offs. This path demands leadership that prioritizes credibility over comfort. It also requires resetting public expectations, not through fear, but through clarity about what is possible and what is not. The difference between stagnation and resilience lies in whether governments use limited options as justification for inaction or as motivation for reform. Constraints can either paralyze decision-making or sharpen priorities. Countries that succeed will be those that align fiscal policy, monetary frameworks, institutions, and public understanding around realistic goals. This does not guarantee rapid growth or immediate improvement, but it restores the ability to adapt. Governments will always face limits, but losing the capacity to choose is far more dangerous than facing hard choices. The policy squeeze is not a permanent condition unless leaders allow it to be. The final question is whether governments continue to manage decline quietly or take responsibility for rebuilding the foundations that expand options again over time. When managing decline becomes the default, what would convince governments that rebuilding capacity is worth the risk? For deeper analysis on how global economies, policy limits, and long-term shifts connect beneath the surface, stay with the channel.